Hello, dear listeners. Today, let's begin with that famous and actually quite deceptive question that occupies the mind of almost every trader from day one, often even costing them their sleep. Where will the price go next? If you find yourself piling dozens of complex indicators onto your charts, waiting for oscillators to cross, or searching for a magic formula to answer this question, the legendary trader Joe Ross renders this question invalid from the very start. According to him, trying to predict the future of the market is no different from sailing a trackless sea without a compass. Joe Ross's approach, crystallized over 50 years of experience, is not an art of prophecy but a mastery of pure structural reading. The sharp line that separates Ross from all other analysts and market gurus is his firm refusal to be a seer, choosing instead to be a market reader. In his world, price movements are never completely random. However, this does not mean it is possible to know exactly what will happen in the future. This paradox, the fact that the price has a structure while the outcome is always uncertain, forms the unshakable foundation of Joe Ross's entire trading philosophy. The concept at the heart of this philosophy, known as the law of charts, is technical analysis in its purest and most refined form. Ross defends a premise that seems quite ambitious upon deep inspection, but has been historically proven thousands of times. The chart of anything that has value and is subject to supply and demand, whether it be the seasonal water level of a river, random numbers generated by a computer, or the stock of the world's largest company, must produce specific structures. This is because a chart is actually the visual result of a process. However, the primary driving force that distinguishes financial market charts from others is human behavior itself, collective psychology. Every candlestick, every wick, or every gap we see on the charts is actually an emotional footprint. Fear, greed, impatience, hope, and disappointment are the ink of these traces. According to Ross, technical analysis is not about struggling with the mathematical formulas of indicators, but about making sense of the structures formed by these human traces within the current context of the market. For Ross, a chart is not a signal board, but a living and constantly changing map of behavior. When we begin to read this map, we encounter the 1-2-3 formation, which Ross introduced to the literature and is now indispensable in the professional trading world. However, we must make a very critical technical distinction here, as this structure is often one of the most misunderstood subjects. Most amateur traders, when they see a 1-2-3 structure on a chart, attempt to use it like a simple buy or sell button. For Joe Ross, a 1-2-3 is never a standalone mechanical entry signal. It is background information, a way of reading the market's current intent. A 1-2-3 structure forming at the end of a trend or at the exit of a long-standing sideways market whispers to us that the market is making a serious attempt at a direction. Point number 1 is where the previous movement has become exhausted and lost its breath. Point number 2 represents the first determined attack of the new direction. Point number 3 is that psychological boundary where the market's attempt to return to the old familiar direction ends in failure, meaning the opposing side has begun to give up. Classic technical analysis books usually tell you this: buy when level 2 is broken to the upside. However, Ross stops there and warns you sternly. The place where everyone enters is usually the most dangerous place, where professionals are waiting to take profits and exit. Big players, institutions, and algorithms know very well that small traders stack their stop levels and entry orders exactly at this obvious level too. At this point, the concept of the trader's trick entry, or TTE, the greatest proof of how clearly Joe Ross reads market realities, takes the stage. Rather than being a formation, the TTE is a masterpiece of timing and strategy that turns market liquidity traps and stop hunts into an advantage. Ross realized that if a market is truly strong enough to break point 2 and continue on its way, it will leave small footprints, micro-level clues, demonstrating its strength before reaching that point. The TTE entry captures those brief pauses and low-volume correction bars that the price makes during its journey from point 3 toward point 2. By the breakout of these bars, we enter the game before the main breakout occurs and before the massive crowd rushes in. The technical logic here is tremendous. If we can enter the game before level 2 at a more advantageous cost, we are already in profit by the time the price reaches that critical and volatile level 2. Ross calls this the free trade phase. In other words, even if the market sets a trap in that area, we have already minimized our risk or moved to break even. However, the most vital condition for the TTE is the principle of space. If the distance between your entry point and the target level 2 is not wide enough to cover transaction costs, give you breathing room, and neutralize your risk, that TTE means nothing mathematically. Joe Ross reminds us at every opportunity that an uncalculated risk without a statistical basis is more dangerous than even the most perfect-looking formation in the world. When we go one step beyond this structure, we see the fuel that ensures the continuity of the trend, the Ross-Hook structure. The first meaningful correction that occurs after a 1-2-3 structure is validated and that famous breakout happens is a hook for Ross. This hook confirms that the trend is resting healthily, profit-taking is being met, and the market is gathering strength to go further. However, looking at every hook we see as a trading opportunity can lead us to ruin. Ross rejects even the most flawless-looking hooks when the market is overextended, when volatility is increasing uncontrollably, or when the price is trapped inside a zone of indecision. His famous saying is like the constitution of a successful trading career: not every opportunity you see is your opportunity. This approach turns trading from a game of frequency into a game of high selectivity and patience. For a disciplined trader using Ross's systems, sometimes only 2 or 3 valid trading opportunities arise during an entire month. Professionalism is the ability to sit in front of the screen without moving a finger, without getting bored, until those 2 real trades appear. This is exactly where most traders lose. The desire to trade gets ahead of the discipline to take the right trade. Perhaps the least talked about, but the part Joe Ross emphasizes the most, and is even the strictest about, is the management of risk and targets. In Ross's systems, stop levels are never determined based on current feelings or a random candle on the chart. His stops are based on a completely objective and statistical foundation. Long before entering a trade, historical data is examined to see how far similar structures took the price against the trader, meaning the noise level of that market is analyzed. Targets are never built on dreams or greed, but on taking that safe and high-probability slice that the market is already willing to give you and walking away from the table. Perhaps the pinnacle of all Joe Ross's teachings and his most revolutionary message is this: you never think during a trade. The analysis process, the setup of all scenarios, and the risk allocation must be finished long before that order button is pressed. Trying to perform a new analysis after the order has been transmitted to the market only invites adrenaline and fear to take over logic. A real trader should act like a machine that simply executes its own plan to the letter after entering the order. This is exactly why he compares trading to a tennis match. For a tennis player, the ball sometimes hits the net or goes out. This is part of the statistical nature of the game and is not a personal failure. The important thing is to reach victory at the end of the match. In closing, it should not be forgotten that what makes Joe Ross successful is not the complexity of his system, but the tremendous simplicity it offers. He chooses to solve the natural complexity of the market by trusting the naked structure of the price itself. Trading is not so much a war won against the candles on a chart, as it is an internal victory won against one's own impatience and lack of discipline. If you have a structure like Joe Ross, a mathematical plan, and the will to remain faithful to that plan no matter what, the market ceases to be a field of chaos for you and transforms into a massive map of opportunity. That's all from us for today. Remember that raw knowledge is only potential. You reach real power when you need that knowledge with practice. See you in our next podcast. Trust your strategy and always stay disciplined. Goodbye.